What is up, YouTube? Today we're going to be talking about the correlation between GDP and the stock market. So first we're going to be talking about what GDP is. GDP stands for Gross Domestic Product, which measures the value of economic activity within a country. Or another way it could be said is GDP is equal to spending plus gross investment plus government investment plus government spending and revenue created from exports and imports. Or it can also be said as money made within a country. So if GDP continues to increase, that means more jobs are created, incomes are created, and it's all a cycle. So let's say if incomes are increased, there's more spending, which leads to more income, because one man's spending is another person's income, which again leads to more demand of certain products and services, which drives employment up. But again, if there's layoffs and less employment, then people will spend less, which will lead to more layoffs, and that will lead to economic contraction. Now, if you didn't understand, contractions are basically when the GDP goes down from the previous quarter. So let's say in 2019 quarter 4 we saw like a 3% return, and now we're seeing a negative 4.8% return. That means more people have lost their jobs, and yes, we are seeing a negative 4.8% growth in GDP as of quarter 1 2020, which means a lot of people have lost their jobs. Around 22 million plus Americans have lost their jobs, and this right now we're basically in an economic recession. Now there are two big differences between economic recessions and the stock market crashing. So economic recessions are when we see 2 consecutive quarters of GDP negative growth, which means the amount of money made within a country is less and less every quarter. And if we see 2 consecutively, that means in a row, then we are officially in a recession. And recessions are where a lot of people lose their jobs, incomes are down, and spending is down, and businesses run out, they go bankrupt. But a stock market crash is where we see like a 20+% decline. The stock market reacts pretty quickly. Sometimes it takes some time. And what I want to talk about is what is the exact correlation. So the GDP has been increasing at a rate of around 3% since 1947, so 50 plus years, and the stock market during the same period has been increasing at a rate of 8%. So the gross domestic product, or the income made in a country, is increasing because incomes are increasing, there are more jobs, bigger population, etc. Now, the stock market isn't just based on the country's economy, but also what the investors are thinking. It's the same supply and demand chain that drives up GDP. Instead, to drive up our economic input and output, it's based on supply and demand for certain services and products. But in this case scenario, it's supply and demand for actual stocks. So let me say an example. Let's say the stock XYZ that has terrific earnings reports, great growth, great management team, then a lot of people are willing to invest in it and are willing to pay more for it because they think they'll make a greater return. And as more investors want it, there's less supply for it and there's more demand, which drives up the price. But again, let's say a company has a terrible earnings reports, then that will drive down the price because there will be huge sell-off and there's more supply than there actually is demand. And obviously, if the U.S. economy is in a good place, there will be more investors. And if it's like we see a terrible economy, then investors will be scared to invest in it. So stock market basically reflects the U.S. economy, the companies that are invested in it, like their earnings reports, the balance sheet, etc., and also what the investors are thinking about the certain stock, index fund, ETF, etc. And that is the correlation. But quarter 2, right now we're not seeing a crash. If anything, we've seen a great rise since our 30% drop in March, and I have discussed that in another video why it crashed and why it might crash again. But this is basically telling us that we're gonna see another correction sooner or later, because quarter 1 is negative 4.8%, which is a lot worse than 2008 9 recession. But quarter 2 of 2020, analysts are expecting a negative 20% drop. Now let me tell you why. So quarter 1 of 2020, the coronavirus affected the last month and a half of business. But for this quarter 2, it will affect all 3 months of business, and most businesses will still be shut down, and I do think the lockdown will still be in place. even though they're saying, they'll slowly open up the economy, I think just for businesses that are needed. But for luxury items, companies selling luxury things, especially restaurants, Starbucks, etc., those will be hit the hardest. And only like hospitals, pharmaceutical companies, those will be open. So if we do see a 20% drop, that means even more layoffs. We'll see a huge drop in income. We'll see more businesses going bankrupt, and that will eventually reflect on the stock market, and we will see a correction. We should see a correction again. So the stock market reflects the US economy as a whole, and also investor emotions. So that's why when we see like a huge drop in the stock market, the first headline we see is there's been a huge sell-off in Wall Street or something like that, which means a lot of investors sold their shares within different companies. When a cure comes, then employment will slowly go back up, incomes will slowly rise again, which will lead to more spending and economic expansion. So I hope you guys found this video valuable, and if you did, leave a like and subscribe, and also comment down below what videos you'd like to see, and thank you.